Alrighty. Good evening, everybody, or I guess afternoon. I'm recording this for Monday, August 15th, just after the market close, real quick. Gonna be a fairly short one, but some good information for you to take home, and some information I wanted to reiterate that I've shared before. So, again, welcome to the Hurley Investments market commentary. My name is Keith Bybee. Fill in for Kevin today. So let's get right into it. What are we doing right now, and what do we think of what the market is doing? So we'll get into a little bit of our big picture. What's happening with our market? We've had this nice bull run you can see on the chart to your left, and getting pretty close to that 200-day moving average, and still could possibly run up to a 4,600 where it topped before falling below a 200-day moving average on our S&P. But what is carrying all of this? It has pretty much everything to do with the fact that our CPI, Consumer Price Index, looked like it was topping out with their last report. Still very high. So the total CPI was unchanged, aided by a drop in energy prices, and was up 8.5% year over year versus 9.1% in June. So market loved this, specifically because if we have a peak in our inflation, that could also signify a peak in our or at least a less aggressive take, peak hawkishness from our Fed, and slower interest rate hikes moving forward. So right now, that's kind of the word of the street, and that's really what everything boils down to as far as the this little bullish run. We have had some good earnings on stocks, which also has helped through our earnings season this quarter. So, see, one part I wanted to read. There's this X factor they talk about, and I'll let you read more when I get this posted. The July CPI report did not settle anything, and why would it? Inflation is still well above the Fed's 2% target, and just to reiterate, there was no improvement in the core rate of inflation. What we call the X factor in measuring inflation rates remains abnormally high on all fronts. Food up 8.1, shelter 9.9, food and shelter were up 9.7. Oh, all items X these things, so that's why they call it X factor. All items X food and shelter were up 9.7. All items X food, shelter, and energy were up 6.1. X food, shelter, energy, and used cars and trucks were up 6.6%. Medical care, X medical care up 8.9. So they take out all of these things. Everything still is so high, just to single out certain things that are really high, like food, shelter, energy, that type of stuff. Even without all those things, the prices are still high. So what does all this mean? The market had cast a nervous eye towards the July employment report and this July CPI report. The former, the employment report, was stronger than expected, while the latter was weaker than expected. That CPI report, the stock market certainly had a sparkle in its eye after the CPI report. The Treasury market had a speck in its eye. And the Fed, well, it is likely feeling cross-eyed given the disparate nature of the reports. So, and then they just go on to say that it'll be pretty important to see what happens in September, what the Fed decides to do as far as rate hikes. So that's what we're dealing with. A lot of this run and optimism just from that point is a bit silly. So I'll say market feeling a little comfy from CPI report topping out. Much doesn't make sense. Like we always say, one day does not make a trend. Well, one report on inflation where it had come down slightly does not make a trend either. So September will be important. So some things that important to remember. What do we do as some things, sometimes the market doesn't make sense? Well, we follow fundamentals, which were in our earnings report. So I'll say I'll just say, how do we we look at fundamentals with our earnings reports. Which a lot of those looked good. Ford looked amazing. Some stuff was just okay as far as ours. We look at our technicals. Fundamentals are more important than technicals. Technicals give us an idea of herd mentality. But sentiment trumps all of that. So how do we look at sentiment? How do we measure it? We look at open interest. Oh my goodness. If you look at option spread, shows open interest. And that's just kind of how much bidding is going on for options. We look at put call spread, give you an idea for what had this you go to CBOE. Oh, whoops. Get that back here. This is just a screen grab for a for this slideshow. Look at the VIX, put call ratio, company news. But I have a screen grab from the CBOE. You can just Google CBOE put call ratio. It shows down here, kind of at the bottom. You see it gives you the ratios for the indexes. Index put call ratio. Those are the ones you kind of want to look at. VIX. But all that does just shows how many more puts versus calls. Why is that important? So let me give you a little definition here on Investopedia. So rising put call ratio or a ratio greater than 0.7 or exceeding 1 means that equity traders are buying more puts than calls, which suggests that there's a bearish sentiment. Conversely, a falling put ratio or below 7 and approaching 0.5 is considered a bullish indicator, means more calls are being bought versus puts. So we'll go put call ratio. Shows how it's been around 90 today. So a ratio greater than 0.7, closer to 1 means the equity traders are buying more puts than calls. So currently we're still in a more conservative, I guess there's more, the sentiment currently is a little bit still on the bearish side, as there's a little more puts being bought. So we just take that into consideration. It doesn't mean that we go and buy puts right now and do that. It's kind of stayed consistently around there, as we're kind of just still in a bearish market and just in a shorter term bullish trend. And then we look at our VIX, which, just to look at real quick, still high, but on the lower side, getting close to a bottom here. Puts it in a chart form as if you're buying a stock or looking at a stock, but it's kind of different. Obviously, higher means more uncertainty, and typically comes with when the market is falling. You kind of see these two side by side. They trade somewhat inversely. Especially these last 2 months, you can see the market kind of bottom out in June and the VIX top out in June and go opposite directions. So all of these things, they kind of give us a little bit more tentative outlook. Right now, we are just looking at seeing where our stocks get out to. We are getting to the overbought level on this S&P, and but some of our stocks, a long way to go till before they get to 200 moving averages. But see how don't think a Meta or some of these similar ones, Under Armour, just getting above 50 days. So they've got plenty of room to run, but doesn't necessarily mean they're going to get all the way up there. But for the time being, they're going up, so you kind of just let them go, right? Got a Ford here hitting the 200 day, but we still have you know, the potential that it could continue up because they did just so incredibly well on their earnings report. So we'll leave that for a day and just kind of keep an eye on it and see whether it can pass that point or not. So just taking things a day at a time. Got the big picture here. Oops. And really that's pretty much all I wanted to go over. Again, fundamentals important, most important. Technicals kind of helps us in the short term, but really sentiment trumps everything, and it's also the hardest one to really gauge. And you know, we showed some of these numbers here, but the reality is what is the market doing, or let's say it this way, how is the market reacting to current news? Right now, so we follow the trend. Until it changes. All right. Dow's getting close, hitting that 200 day. S&P we showed you, not quite. A little further for the NASDAQ to get there. Well, where will our markets, where will the S&P end in August? I'm saying up 2%. That's as we get really close to these 200 days. If we hit that and can't get over it, obviously that outlook is going to change. Some of our earnings, we've got a lot of retail. Zip is more of the employment one, ZipRecruiter. We've got Home Depot tomorrow, Walmart tomorrow, Wednesday, Lowe's, Target, Thursday, Kohler, Friday, Buckle, Deere, and Foot Locker. So for the most part, a lot of retail earnings, which is important for kind of gauging our retail spending and retail and sentiment. So econ reports, we got housing market on Monday, that's today. Housing starts, building permits, industrial production on Tuesday. On Wednesday, we got more mortgage apps, retail sales, EIA, oil inventories, FOMC minutes. Thursday, initial claims, continuing claims, existing home sales, and natural gas inventories. Down here on some of the where we usually have our linked articles. This is one I put back on from June when I was doing our market commentary last. I still feel that it's relevant. And if you haven't gotten a chance to read, this is another Howard Marks article on bull market bull market rhymes, not crimes. That would be an interesting article. Someone needs to write that one, bull market crimes. But some important points, and this goes right along with our sentiment, talks about cycles and bull markets and what drives bull market psychology. Here's a good point. Eventually, investors concluded from this bull market, as they often do when things are going well, that they could expect more of the same. Generally, investors are willing to put more money towards riskier assets in bull markets. There's fear of missing out. He says the most important thing about bull market psychology is that, as cited in the final bullet point above, most people take rising stock prices as a positive sign of things to come. Isn't that interesting? Retail and everyday investors start to get clued in on things after really it's already taken place and after the fun's been had. And then everybody gets optimistic and then it changes. Bull markets are by definition characterized by exuberance, confidence, credulousness, and willingness to pay high prices for assets, all at levels that are shown in retrospect to have been excessive. History has generally shown the importance of keeping these things in moderation. For that reason, an intellectual or emotional rationale for a bull market is often based on something new that history can't be used to discount. So, case in point, our situation right now where we have incredibly low unemployment and also incredibly high inflation. And we do our best to look back and get an idea for how history has played out, but history doesn't always, it always repeats itself. We know that, but in some cases, different parts of history, in this case, where unemployment is so low and inflation so high, some of these things haven't happened at the same time. And so we kind of are going in the dark a bit. Another bull market theme that rhymes from cycle to cycle is the deleterious impact of bull market trends on the quality of investors' decision making. In short, when burning optimism takes over from level-headedness, assets price rise, greed grows relative to fear, fear of missing out replaces fear of losing money, and risk aversion and caution evaporate. Let me see. Anyways, this is a good one. Just read the whole thing. It talks about SPACs. It talks about, the silver bullets that come along and make regular investors think that, this is going to be different this time. And SPACs is a great case in point that, you're not going to lose your money. You can get your money back, but if the company sells like a SPAC is supposed to and designed to, it could sell for much lower than it IPO'd. And those are some risks that are just stupid to be willing to take. So don't be stupid, be smart. That's really all I had for you today. Come and join us again Thursday. Kevin should be doing our trade findings and adjustments as we kind of switched off this week. So come back out Thursday, listen to what he has to say. And until then, take care and enjoy these last weeks of summer. Thanks again, guys. Bye.